The markets are uncertain. No matter what anyone tells you, we never quite know exactly what's going to happen.
You're a wizard, Harry.
When we're trading, we're making estimations and predictions about what the future may hold. But this means that whenever we have a trade open, there are obviously risks involved. But rather than living in a bubble and completely avoiding life's risks, just like Bubble Boy, instead we can take some measures to control the amount of risk we're exposing ourselves to and how we're exposed. This is, of course, what most people refer to as risk management. A lot of traders think this is only about where you place your stop loss when you open a trade, but actually, the world of risk management is extremely complex and exciting. Okay, maybe the word exciting is a bit of a strong word there. Maybe complex and interesting? That sounds best to me. Now, in this video, I want to give you something that you can add to your arsenal that we use with the Duomo method that's called a probe trade. And this is going to help you with your risk management. So in this video, I'll be explaining to you what a probe trade is, the difference between a probe trade and a small full trade, situations when we might use a probe trade, and the pros and cons of using them. And just before we get into that, if you're new to trading or you're just not making the progress that you hoped for, make sure you check out our free course, Introduction to Trading the Duomo Method. You'll get started learning the foundations of our approach to trading in a really cool learning journey. So, what is a probe trade? Well, surprisingly, it has nothing to do with the sort of probing you might be subjected to from an extraterrestrial life form. Instead, this is all about how we approach trade opportunities when there is an additional element of uncertainty that we need to account for. So, this means situations where the opportunity itself matches our entry criteria to open a trade, but there's just something else going on that's causing us to have some doubts. Technically, the situation does match what we need to see to pull the trigger and open a trade, but while that additional uncertainty exists, we feel like we're taking just that bit too much risk, at least temporarily. Not enough to hold off the trade completely, but enough that it may just disrupt the entry. Another way to look at this is that the entry right now has a particular estimated success rate that makes it a viable trade for you. But if that extra bit of uncertainty was gone, removed from the situation, the success rate would be a lot better. It may even be that in some cases, that uncertain factor has a very good chance of disrupting the trade entry and putting the trade initially into a loss before it starts moving into a profit. So we don't want to miss the entry, but once the uncertainty is gone, the success rate is either going to be much better or we can have a much better entry point. So we want to save some of the position size for that trade for a possible scale-in. So with a probe trade, what we're going to do is to enter part of the trade at the initial entry and then scale it up to the full trade once that additional uncertainty or risk is gone. To use this approach, you need to already be using dynamic position sizing, where the size of your trade is going to vary depending on the type of opportunity that you have. For example, some trades might be 1% at risk, others 0.8% at risk, others 2% at risk, and so on. When you have a trading opportunity that calls for a probe trade, you would start off by first figuring out what position size you would use if that additional uncertainty wasn't there. What position size would you usually use for a trade that matched that entry criteria? Let's say that you decide it's going to be 1% at risk for that sort of trade. That's your full trade size. However, with the additional uncertainty, you might decide to open a probe trade of just half that amount and scale into the full trade after the uncertainty is gone. So in this case, your initial entry is going to be 0.5% at risk, so half the full position size, and you'll scale up to 1% at risk once the uncertainty is gone. Now, you may be wondering how this is different to just using a small full trade, but there is an important difference between a probe trade and a small full trade, and it's all about where you're capping the maximum amount at risk for that setup. So if we go back to our example we had a moment ago and go back to when we were choosing our dynamic position size and assessing how much we want to have at risk for that particular setup. In our example, we chose 1% at risk, and this was based on the dependability of the setup, okay, how dependable that setup is. However, if we look at the opportunity, the one that's meeting our entry criteria, and we can see that it's a less dependable setup, we might choose that we want to have 0.8% at risk. Or it may be that it's not very dependable at all, and therefore we're going to only open with 0.4% at risk. That's your full trade size, okay? That's the decision you need to make at that point. For me, it's going to range anywhere from 2% as my maximum for a full trade down to about 0.4%. Anything lower than 0.4%, and I usually just won't take the trade because I won't want to hold the risk for something so small. So your full trade may be a smaller position size or a larger position size based on how dependable the setup is, okay? In most situations, you're just going to open the trade with the full trade. It's fine to open with whatever you decide at that point. However, when there's this additional element of uncertainty that may disrupt the entry, you might choose to open as a probe trade at first. And how much of a probe trade you choose to go for will vary depending on how disruptive this thing is to the entry. Now, once that disruptive thing is gone, you can then scale into the full trade. So the full trade is about how dependable the setup is. The probe trade percentage is about how disruptive the uncertainty is. So let me give you a quick analogy just to help get the point across. Imagine that you're running a bath full of water, because you need to get clean before your date arrives at the door, which could happen at any moment and time is ticking. If you saw the temperature and knew that the water in the bath was boiling and would blister your skin, you wouldn't be crazy enough to jump into that bath, would you? You wouldn't enter the bath. On the other hand, if the temperature was warm, you would know it's a good opportunity, so you would jump straight in. It's a good opportunity to enter, you're getting in. However, if it seems that the bath water was a bit on the hot side, you might approach it differently. You know your date's arriving at any moment, so if you don't go in now, you might miss your opportunity. You might miss your chance to get clean. But if you jump straight in, it might be too hot and be really uncomfortable, maybe make you blister or at least go bright red, which is not going to be a good look. So what do you do instead? You'd probably put a foot in first. You'd probe into the water and only go fully in once that uncertainty is gone. Now obviously this isn't exactly the same with our trading, but it is similar. We don't want to miss our opportunity to enter, but until that additional uncertainty is gone, we don't want to fully jump in and fully commit. Got it? Now with the Duomo method, we do also scale into our full trades to increase our position size. It's not just with probe trades, but that's a completely different situation, and it means adjusting other aspects of the trade to balance the risk. That's part of our trade management, and that's something we'll discuss at another point in time. But an important thing to note is that we never scale in with our full trades if it's in a losing position. We never add to losing positions. But with our probe trades, we can scale up to the full trade in a losing situation if that's what was required to remove the additional uncertainty. You know, sometimes scaling up a probe trade to a full trade will happen in a losing position, and sometimes it will happen in a profitable position. This just depends on the particular uncertainty that we're needing to remove. There could be any number of reasons to open using a probe trade, but with how we trade using the Duomo method, here are 3 of the most common reasons. The first reason is that with the Duomo method, we open trades based on a double confirmation in most cases. This is when there's a confluence between 2 different significant levels and we get the correct entry criteria on both of them at the same time. Now, if both levels are confirmed, we would open that trade as a full trade. If neither of them are confirmed, they're both unconfirmed, we won't open a trade at all. But if there's one that's confirmed and the other one is unconfirmed, we could open as a probe trade and scale it up to a full trade as soon as the unconfirmed level is confirmed. And sometimes this will simply be the reaction that we get at the trade entry that could confirm it itself, depending on the situation. The second common reason is for situations when we have a trade entry, but there's a major level just nearby in the sort of negative direction of our trade that could attract the price to it and disrupt our entry. Now, we don't want to miss out on the trade entry in case the price does react as we expect at the setup we're at, if there's still a high enough success rate, but we maybe want to leave some of that position size to be able to scale in if the price is attracted to that major level. So in this case, we open a probe trade at our setup, and once that extra uncertainty of the major level that could attract the price is gone from the market, we can scale into a full trade. And the third reason would be in situations when there is weakness in the market structure. In this case, we might have a strong setup, but with weakness in the market structure, we might choose to enter as a probe trade until the structure is stronger and more certain. So in this case, probe trade first, scale in afterwards as the structure starts to move more in our favor and is no longer weak. There are many benefits of using probe trades. One of the key ones is that rather than just blindly following your entry criteria in all situations, you can actually account for the context of a specific situation. You know, when we build our systems, we can't account for absolutely everything that may happen. So probe trades allow us to just dip our toe in the water and only commit once the entry criteria is not being affected or disrupted by some extra uncertain factor. Another benefit is that sometimes if we wait for that uncertain factor to be gone before entering, it means that sometimes we'll actually miss the move completely. So at least by having a probe trade, we can still profit if the move does take place without going full risk if the uncertain factor does disrupt things. Now, on the other hand, one of the downsides to this is the fact that you're opening a position in a situation where there is an uncertain element, and this can sometimes be difficult to measure. Another downside is that this is a bit of a grey area, and you're relying on your ability to estimate how the different uncertain factors will affect your position. And this can be particularly difficult for new traders. As you get more experience, it becomes more second nature. And finally, it means that you may overcomplicate situations which then confuse your trading or make you more inconsistent and even sometimes cause you to fall into the temptation of using a probe trade as an excuse to enter in situations when really deep down you know you shouldn't. So there are pros and cons to this. You have to keep these in mind. So overall, I think you should identify situations when a probe trade may be appropriate in your system and then have rules about when you can or can't use them. For some people, they won't be useful at all in their systems, but if you're using the Duomo method, then they can be really helpful. Now, if you want to know more about risk management, why not check out this video over here? In fact, it's a playlist. And don't forget to like this video if you want more on this topic. Thanks a lot for watching, guys. I will see you in the next one.